minute chart, it's kind of obvious that we've got a beautiful rejection of a high price here. But if we dissect that and try and figure out how we could have traded that, then it's very, very important. Because it turns out that if we could have traded that, we went 35.05 to 34.60 this morning. Now, I don't know about you, but that's a pretty big move on gold, isn't it? That's a pretty big move on gold. That's a very, very substantial 50 points. Huge, right? So by finding this trade this morning, it's a great time of the day. It's 7 o'clock. I'm surprised I haven't seen many screenshots from Reeve showing me just how much money he made on this sell. But let's just deal with the trade first. If I put the traps indicator on it on this time frame, you'll see it doesn't find that trade at the top edge. It doesn't see the trap at the top edge. It's quite obvious that it misses it for whatever reason. It doesn't find that opportunity. But if I look at this in a more detailed point of view, if I look at it from a switch point of view, it's quite obvious that we do find the switch. If we look at it from the cap point of view, it's quite obvious that we've got a nice slippy cap below us as well. And I always like to sell into the slippy cat narrative. So let's get into the switch itself and try and figure out. Let's get into the switch itself and try and figure this out. Now, for the switch, we need to see the imbalances. We need to see the imbalance in the order flow going in. We need to see the imbalance in the order flow going out. Now, why is that important? Because I'd like to see the imbalance on the way in getting taken off the numbers. Why? Well, because there could be a commercial buyer at that location. If it hasn't been taken out, there still might be a commercial buyer in that location. And therefore, I need a bit of space to take this guy on. So let's take a look at the imbalances going into the area. So we can see where the imbalance came from. It was this imbalance here. So we get that toxic candle right there. So part of the switch process, we really want to take out that imbalance, don't we? And we do take out that imbalance. There's always a chance that that guy is sitting there with a buy order waiting to get long the gold market. So when the price takes that guy out, well, we know that they're not there anymore. So that's great news. So we've now got the rejection of the high price. We've now got a beautiful bottom edge to target into in terms of the first target, and a huge bottom edge to target into in terms of the bigger picture here. You can see that the last time we saw a bottom edge was just in here, right? So that's another location that we can try and go after once this guy here's taken off the numbers here. So we've got a great setup of trades to kind of go after. We've got a great idea about how to play this. Now, so we've taken out this guy after rejecting the high. That's good news. And that means that we've got one piece of the we've got two pieces of the jigsaw. First of all, we've got the rejection of the high. And secondly, we've now taken out the imbalance going into the level. There should be nothing stopping us now from making money on this trade if we're bearish. And that's the next big question. Are we bearish? Well, it's gold. We want to know about gold versus a dollar. So I've got the 6J contract in this. It's quite clear that the 6J contract is very bearish, and we should make some easy money selling gold here, shouldn't we? Easy money. So let's take a look at this. Well, we know that the trade that we're looking for is called the 56 pullback. You can see that we've got the cat trade here, the black and red line here. I'll move this away from that black line. So you can see the cat trade in the background just there. So there's the black line, there's the red line. We've got that slippy red line showing up. If it's not crystal clear, okay, I haven't got that with the settings on it yet, so we'll have to get that changed. But you can see it's crystal clear. It's slippy on the sell side, sticky on the buy side. So we're going to be using that to help us. And this is called the 56 pullback trade just here. You see it? So the imbalance that then takes out that buyer, that creates this candle area here, which we know is, I was going to type in 56. They've added a wee bit of extra here, haven't they? There we go. Thank you very much. So this is now the 56 pullback trade here. What the hell happened to it? Oh, there it finally shows up. Good. Okay. So when the trade pulls back into this area, we want to start drilling down the time frames to find that sell trade, don't we? We want to check our order flow. We want to check our reads. Our first target price is going to be this area here, and our second target price is going to be this area here. And that's it. So, even though we didn't get the trap on that candle, we're still able to see it because the trap is part of the bait and switch process. The baiting part of the process, the idea of the trap was to try and get you in as early as possible into that trap top edge here. But sometimes, because of the number of candles that forms from it, it doesn't show up. And we've got to be better than simply the indicator itself. We've always got to be better than the indicator. And the idea is that we are able to then recognize that trap trade here and take our shot, don't we? And with the value that's now very bearish, it's almost a formality that getting a short sell here at 745 is an absolute given. The trade there was at just below the 35 handle. It traded to just below the 34.60 for $4,000 profit per contract by the time we reached that second target price. Unbelievable trade. You might also recognize that there was also this capper trade area here. When you've got the black line, you draw a candle up into an area where you've seen some selling. You draw it up into that green candle there, and you use that as a possible trade location as well. So when you've got the cat trade there, this green candle into that area makes a lot of sense to keep that selling going. You've already taken some money, I would imagine, in this candle, biggest volume candle of the day so far. So you've already taken money there, and now you've added back in here, and you're now swinging for the bottom line price, which is then duly served up on a plate into the bottom edge price there for a walk away. And that's the perfect trap trade. It just unfortunately doesn't show a trap trade on this time frame. And you might say, but could we start drilling down? Yeah, but it's still, if it doesn't show up, it doesn't show up. It doesn't mean it's not there. It just means that based on the setup parameters that we've got in these areas, it simply didn't conform to the setup at that stage. And that's the problem with any of these types of indicators. And you can see if we drop it down into a time frame, it did find the trap on a 1 minute chart. You see it? So it did find the trap area on a 1 minute chart into that top edge, and you could have said, right, I've got the trap here. We'd already seen a trap over here, and you could have looked at that and says, right, I've got a trap area there. Draw it down then into the 30-second chart into that area, and you'll start to see the trap getting closer and more accurate to the actual price itself. And then you're looking at it coming away from that area, and obviously the trade away from that was quite beautiful, wasn't it? Quite a beautiful sell trade. So it is what it is. This trade, even on a lower time frame, becomes its own trap. It doesn't have a 56 on that, that situation that trades, of course. But it's now on a downtick. It's a safer trade because it is now a double distribution to the downside here. This is basically what we call a spring trade here, which is now a 56 pullback on a higher time frame. But that's basically your common spring trade there. And, just working through these ideas, candle by candle, value by value, storyline by storyline, you can see just how strong that sell trade really was. It's an incredibly powerful sell trade opportunity, isn't it? It's just perfect. It's like your benchmark coming home and saying this is like one you want to take a screenshot of because it's that good a benchmark trade up here. So that's the trade of the day for as far as benchmarking is concerned. I think that's the winner everybody needs on their portfolio. You can see the big arrival of volume into that 56 area, something that's probably not caught you by surprise as you come into this area here. There's an increase in volume, and there's also a candle reversal coming in. You can see, as I said, we don't quite get the perfect trade here in terms of, maybe a 1-2 into the top edge, but my God, how many other things do you need at that stage? Get into your order flow, find the lean, and get busy working that offer. And the takeaway from that single bit of business there was huge. 35 handle, trades a low price of 34.70s, an enormous profit. That's enough money for most retail traders to finish off their entire week on that bit of business there. It is spectacular. And as I said, you don't need to see an indicator to see the trade outcome there. You don't need to see an indicator coming into this area to find that opportunity. It's beautiful. If you drill it down on a lower time frame to see if it shows up, it does, and it gives you a brilliant trade. Welcome in, guys. It's just after 1 o'clock. We're back from holidays. If you've had a nice time off or if you've been working, is what it is. It's been a relatively busy start. We've gone through this morning. We've went through the macro S&P so far today, looking at the high beta, low beta narratives. We'll cover that in classroom again this afternoon. But welcome in. I hope you're all good. Let's get through the limited data that we've got available today, and it is limited. Most important to note, 2-year bond auction later on tonight at 1800 hours. So for bond traders, something at least of interest for an otherwise relatively quiet day today. You can see here nothing much of any real interest in terms of data. The Richmond manufacturing, it's losing a little bit of its impact. I've been looking at the impact that this number has had recently, and it's kind of losing a little bit of its impact most recently. So nothing really terribly exciting about this number today. Consumer confidence numbers out of Europe. We do have flash numbers out of Europe at 3 o'clock today as well, so that might be of interest. But other than that, you can see for yourself IMF meetings kind of overshadowing everything. Might be interesting because there might be some comments from the IMF about tariffs. That's always going to be interesting to see if IMF decide to weigh in on that particular issue. And we'll pick it up from there. But looking into the rest of the week, Wednesday, manufacturing and services PMIs pile in, heavyweight stuff coming out here. Look at the size of the numbers in terms of directionality. Look at the size of the numbers in terms of price discounting. And we do have, quite an interesting set of numbers here, because if you look across them, lower than, 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 and lower than. See all of them? Every one of these European and British numbers lower than. The problem, of course, whilst they are all lower than, is that if we go to the US numbers, they're also lower than and lower than as well. So you're looking at the pricing in of these numbers and you're thinking, well, realistically, that should be buy-side treasuries. That should be the most obvious play out of all of these things, as buy-side treasuries this afternoon after the numbers are out. So we'd be looking at that as a possible pricing in possibility as buy-side treasuries, possibly buy-side the market, for example, gold against the dollar weakness, against yields dropping. These might be things that we can take perhaps FOMO buyer opportunities to trade into tonight for the Wednesday data coming out. So these are all possibilities to try and take advantage of these weaker services and manufacturing numbers tomorrow. And again, if those numbers turn out to be true, sell-side oil seems to make a lot of sense, doesn't it, at high prints? Selling rallies on oil against those weaker numbers tomorrow would seem to be a requirement to price in that storyline. Also, moving forward for the rest of the week, Bailey speaking from the Bank of England, crude oil inventories on Wednesday. Why? Well, because it wasn't a US holiday on Monday, it was a European-British holiday on Monday. So the US numbers coming out at its normal time slot on Wednesday. Thursday, unemployment claims, durable goods on Thursday. And then into Friday, we've got the UK retail sales, Japanese inflation numbers, and some Canadian numbers in the University of Michigan coming out to finish off a relatively quiet session for the US on Friday. But otherwise, the big day for us probably this Wednesday. So we will be watching for possible buy trades on bonds going into this afternoon's late session. If we get any incentive to do that from the FOMO level, that would be fantastic. And we'll be long bonds for this disappointing pricing process here. So welcome in, guys. I hope you're all good, ready to rock and roll. And I'm going to grab some lunch and then we'll get started.